Hello, Mr. Latif. Ẹ kalẹ́ o.
Ẹ káalẹ́ sà, ẹ kújọ́ mẹ́ta sà.
Yes, sir. Ẹ pẹ̀lẹ́ káàbọ̀. Yes, sir. It's good to have you. I miss you.
Okay, class, let us start. It's already 8:40. So that we can have 1.5 hours or 2 hours effective class for tonight. Okay, so you are welcome again. Today, we are looking at one of the very last major accounting standard for this diet. After this accounting standard, when we are done with that, with this standard, the standards we have left are minor ones. Another major topic I have to teach you after this one is ratio. Then probably we'll then solve questions on published account. But I mean, let's deal with this standard first. So what we have in front of us today is financial instrument. So the first thing we need to quickly clarify is understanding what financial instruments means. That's what we need to quickly clarify. And if you look at the first paragraph of my note, I said that financial instruments are basically debt and equity. And that is true. So fundamentally, what we're going to look at all through this topic would be all about debt and equity. And majorly, debt and equity are useful ways in which businesses and individuals raise money, the way they get money. So if I want to raise money for my business, is either I use debt or equity. So it then provides somebody that have liquid capital, somebody that have cash. It then provides that person an opportunity to invest. So the thing about debt and equity is that there is now always going to be like a two-party to it. There is always going to be at least two parties, because for one person that wants to raise money, either with debt or equity, there's always another party that is investing. Okay, so those two parties are those we want to look at tonight. And when I say debt, if I want to raise money through debt, I hope you all know that what that means is that I want to borrow money, which means I will definitely have to pay back that money. So if I raise money through debt, it means that I have to pay back at some future date, of course. But if I raise money through equity, I won't have to pay back that money, just that I have to be giving them dividend if I make profit. So if I raise money through equity. So the implication of raising money through equity instruments is that I will lose some of the ownership of my company to those other people. So, but I mean, the good thing is that the money I collect from them, I'm never giving them back. At least it's not coming from me. So, but I mean, if the businesses does well, I pay them dividend. So it's useful. Debt and equity instrument, extremely useful. And some decades ago, yeah, because what I want to actually talk about is like over 10 years ago. I went to a banking hall to collect some money, right? So a guy came in, talking about around 2008 or thereabout. So one guy came in. The guy went to the cashier and was like, I want to see your fucking manager. The all of us were amazed that, okay, what's happening? The cashier also raised up, the man repeated himself. I said, I want to see your fucking manager. Then, please, we don't have a fucking manager here, please. Can you please leave our banking up? So the cashier responded to the guy that way. But the guy was like, I said, I want to see your fucking manager. So they had to call security, please come and escort this man out. Apparently, he wasn't happy for the fact that they said he should leave. He was not happy. So he was shouting, okay, this is a fucking bank. This is a fucking bank. So the manager was upstairs. So the guy was coming. That was happening in my branch. So the guy was coming down and he was hearing the guy that was happening. So the guy that they said he should leave was like, okay, I'm going to leave this fucking bank. I will take my $1 million to another fucking bank. So I guess the manager had $1 million. So the guy went to meet the guy. Are you serious? $1 million? And yes. So okay, I'm the fucking manager. Let's go and discuss in my fucking office upstairs. I was amazed how this guy was ready to, how he quickly just easily put himself down when he had of $1 million. And you see, the business of bank, for example, now is a business where all they are looking for is this debt. So if I want to put it, let's say generally, I would say all banks are looking for is financial instrument. I mean, debt is a financial instrument. For the fact that you go to a bank and deposit your money, you're depositing your money to the bank is a debt, to them. So the topic we want to look at today in the next 1.5 hours, or maybe 2 hours, is extremely important because it is debt and equity instruments that makes small businesses, that makes whether startup, that makes them to continue to operate in business. Because if they don't have these financial resources, which is debt or equity, there's no way they can continue to operate. They need that liquidity. And that is financial instrument. It's extremely powerful. So now, for this topic, basically, we're going to consider two standards for this topic. One is IS 32, and it's called Financial Instrument Presentations. The second one is IFRS 9. This is called Financial Instruments. These two topics are what we're going to use to treat this. Today, we'll quickly discuss some part of IS 32 that talks about the objective and scope of financial instrument, how you classify a financial instrument into liability and equity, and how you present compound financial instruments. While IFRS 9 would focus on recognition, derecognition, and measurement. Impairment and aging is beyond the scope of your syllabus. IFRS 7 is beyond the scope of ICAN. ICAN doesn't even look at it, but it exists. Now, this standard would explain the principles. That is, IS 32 will show us how we can present financial instruments as either liabilities or equity. Don't forget, I told you that financial instrument is debt and equity. So IS 32 will teach you, will make you know that, okay, when have we raised money through debt? And when have we raised money through equity? I mean, even before me teaching you, it should be particularly clear to you. And of course, you need to establish that other party that is making the money available, who is the investor. So IS-32 will teach us all of that, and also the principle of offsetting. So I won't really talk about offsetting here with you guys, but it exists. So everything I'll be teaching you here today, you need to be able to draw a line of distinction between this and what Mr. Kazim is teaching you on that group account. So the difference, because if you look at group account also, is about investment also. It's actually financial instrument also. One company investing in another, investing in their equity, buying shares, right? So it's a debt, it is an equity instrument investment. So the difference between that group account and here is that it now depends on what the volume of shares they are buying. By the time you buy shares in another company, and it now results in you having a subsidiary investment, associate investment, or joint venture investment, then it's already beyond the scope of IS-32. IS-32 is that does not give rise to any of this. Because by the time you are talking about subsidiary investments, which makes you have control of the investee, then you're talking about IFRS 10, or your investment in shares in that other entity makes your investment associate investment. This is covered in IAS 28, or a joint venture investment, which is covered in IFRS 11. So you see, our focus here is how to account for equity interest. I mean, if I want to look at it from the angle of holding interest, we're talking about those ones that are less than 20%. 20%. But from your knowledge of group account, I'm sure that you understand perfectly well that beyond holding interest, what can make an investment associate or subsidiary is beyond the fact that you have at least 20% to make it associate, or at least more than 50% to make it subsidiary. You should know that the key indicator for subsidiary is control. The key indicator for associate is significant influence. But again, looking at it from the standpoint of holding interest, then if your holding interest in another entity is less than 20%, then that is what we want to look at here today under financial instruments. Okay, so I've tried to paint a picture around what financial instrument is to open your mind to what we want to discuss today. However, what is financial instrument in line with IAS 32? Financial instrument, according to IAS 32, is defined as any contract that gives rise to financial asset of one entity and financial liability or equity instrument of another entity. Financial instrument is any contract that gives rise to financial asset of one entity and financial liability or equity instrument of another entity. Looking at this definition, there are 4 items here that are key. Number 1 is that there has to be a contract. For we to have a financial instrument, there must be a contract. A financial instrument is any contract. And from the knowledge of IFRS 15 that you had, because I taught you IFRS 15 like 2 weeks ago, you already understand that a contract is an agreement that has an enforceable right and obligation. It's the same thing here too. It's an agreement that has clear economic consequences, which means the parties cannot avoid it. usually because the agreement is enforceable by law. And very importantly is that a contract need not be in writing. It's simply an agreement that has clear economic consequences. It's just an agreement in whatever way we want to agree. Once we agree, and each parties consent and agree, we have a contract. It doesn't have to be in writing. So for a financial instrument to exist, there needs to be a contract. And this contract will give rise to three things. Number one is it's going to give rise to financial asset of one entity. That's one on one side. And a financial liability or equity instrument of another entity. That's the second part. So this definition shows clearly that, of course, there have to be two parties involved for there to be a financial instrument. These two parties in question, one of them must have a financial asset. Another one must have either a financial liability or equity instrument. And you see, to identify the party that have a financial asset is quite straightforward. In fact, is the one that is so straightforward because this party is always the investor. It is the investor that would always have a financial asset. I will define financial asset to you in a jiffy. But the other party that wants to raise money, if that other party is raising money debt, if he wants money through debt, if he wants to borrow money, like he came to you and said, borrow me money, he will have a financial liability. But if he came to you and said that, can you invest in my company? Can you become a shareholder in my company? I need a part owner. Can you invest so that we can be partner in progress? That means that other party will have an equity instrument. So the investor, the person that is putting money down, is the person that has a financial asset. Well, the person that is collecting money, it now depends on how he has raised that money. If he is borrowing money, his financial liability he will book. If he's looking for shareholders, his equity instrument he will book. And that is why this definition goes as it is, that is any contract that gives rise to financial asset of one entity and a financial liability or equity instrument of another entity. By definition, they said financial asset is any asset that is cash. Cash. So when you have cash in bank, cash, or even if you have cash in your drawer, in your office, cash, whether at hand or at bank, the classification of assets in which you are going to present that cash in your statement of financial position is a financial asset. Cash. You don't just call it simply current assets. No. What classification is it? Is it PP? Is it intangible asset? Is it investment property? Is it financial asset? Yes, it is a financial asset. So financial asset first is cash. That's one. Two, financial asset is also an equity instrument of another entity. Don't forget, I told you that the investor has a financial asset. So if the investor has invested in equity instrument of another entity, that's a financial asset. So if he has invested in shares, that's what they call it, equity instrument of another entity. Alakunle, I can see your hand. I need to finish this first. I need to finish this definition. Then thirdly, he says that it's a contractual right to receive cash. I'll stop there for now. Contractual right to receive cash. And this contractual right to receive cash is where the investor has invested in debt. If he has lent somebody money, that is what will give that investor a contractual right to receive cash. You see, this word or this sentence, contractual right to receive cash, is so powerful. So powerful in the sense that when you have such right and you have it for an elongated period of time, you're a rich man. You're a rich man because you won't have to lay a finger to make money. Contractual right to receive cash. You don't have to do anything. They must give you cash. Just do that investment. When you have any type of investment that gives you contractual right to receive cash, in the sense that at certain dates, alert will drop. At certain date, alert will drop. You don't have to do anything. And if that alert does not drop, they're in trouble. Then you have a contractual right to receive cash. That is where you have invested in a debt instrument. I mean, at a very simplistic level, we're going to keep it very simple at your level for your exams. Now, I want to pay particular attention to this other part of this definition, or contractual right to receive cash or another financial asset. I mean, this looks circular. In the definition, they are saying to receive, we are defining financial assets, and yet they are saying to receive financial asset again. Yeah, it has meaning, but I won't really pay particular attention to that for you. And also, it goes ahead to say to exchange financial asset or financial liability with another entity under conditions that are potentially favorable to the issuer or to the entity, as the case may be. But our focus that I need you to remember when it comes to financial assets, at every point in time, know that financial assets is beyond this, right? But primarily for us, for our exam, at least know that financial asset is three things. Three. And firstly is that you need to know that the financial asset is always an investor that will have a financial asset. That one has to be stamped in your mind. Is an investor that will have a financial asset. So when you have that at the back of your mind, then we can then go further. That financial asset is three. Number one is that it can be cash. Number two, it could be equity instrument of another entity. That is, if you have bought shares in another entity, you have a financial asset. Number three is contractual right to receive cash. You have a financial asset when you have contractual right to receive cash. And this will usually arise where you have invested in debts. And examples of financial assets are trade receivables, lease receivable, equity instrument of another entity, cash or check, loan receivable, and bonds receivable. You see, all of this, trade receivable, it gives you contractual right to receive cash. Lease receivable gives you contractual right to receive cash. Equity instrument of another entity is when you have bought shares. Cash, yes. Loan receivable, right to receive cash. Bond receivable, right to receive cash. So that is why they are all financial assets. For financial liability, I mean, what I need you to focus on for financial liability is that is any liability that is a contractual obligation to deliver cash. Contractual obligation to deliver cash. So when you are the one that must deliver cash, then you have a financial liability. Of course, the definition continues, which I will not really want you to really dwell on too much, as this one that I have emphasized is either to deliver cash or another financial asset to another entity, or to exchange financial asset or liabilities with another entity under conditions that are potentially unfavorable to the issuer or to the entity. And examples of financial liabilities trade payables, notes payable, loans payable, bonds payable, lease liabilities. All these are financial liabilities. Okay, okay. Now, Alakule, can ask a question now.
Sorry, sir. I didn't get your explanation on cash. I mean, while explaining financial assets.
What we're explaining to you is, I mean, when you have either money in bank or you have money in your drawer, you classify it as a financial asset because it's just, I mean, that's what the definition says. It's a financial asset is cash, is cash. So it was very specific in the standard. So the standard is directing us that anytime you have either cash in bank or cash at hand, classify it as a financial asset. So why is it a financial asset? Because the standard says it's a financial asset. So I can't really point to a particular reason why cash should be classified as a financial asset because it's just part of the definition of a financial asset. That financial asset is cash. Is what we have to know in reporting. Now, any questions? Any questions? Okay, if you are not asking questions, so I want to believe you all understood everything I've said. So that means I will ask you a question. So let me see. If I bought motor vehicle, okay, if I bought a motor vehicle, can I classify that as a financial asset? If I bought,
No,
let me
sir.
put the definition. You cannot classify it as a financial asset. Why?
Because there is no contractual right to, I mean, receive, um, I mean, financial asset or contractual obligation to deliver cash.
Obligation, Bawo. We are talking about,
I
you
mean,
said the
contractual obligation. Sorry.
obligation care. I'm talking about financial assets. There's nothing obligation has to do with financial assets.
Yeah, in trying to define financial liability.
How are you bringing in financial liability?
No obligation, sir. Okay.
Yeah, I don't know why you're bringing obligation here. So, you're telling me that the motor vehicle is not a financial asset. I say, why? So, you have seen from here, I'm even showing you on the screen, that financial asset is cash. So, motor vehicle is not cash. Financial asset is equity instrument of another entity. Financial asset is equity instrument of another entity. So, motor vehicle is not like you are buying shares in another entity. So, and also financial assets is a contractual right to receive cash. So this is where you might want to think twice. So can motor vehicle give you a contractual right to receive cash? Like if you're using it for Uber or something like that. Can motor vehicle give you a contractual right to receive cash?
Yes, if it is for commercial purpose.
Okay. So that means we might consider classifying motor vehicle as a financial asset. Because any item that meets this definition, any item that meets this definition, that means that item is a financial asset. Okay, but you know that when I taught you IS 16 PPE, IS 16 PPE, when you hold an asset, a tangible asset. So in fact, IS 16 PPE has said that PPE is any tangible asset. That definition alone has already picked motor vehicle to itself. That definition alone has already picked motor vehicle to itself. And not only that, motor vehicle, whether for commercial purposes or for admin, would not even give you right to receive cash. So the fact that you are using it for Uber or probably is downfall that you gave to somebody to be helping you to do runs around, it doesn't give you right to receive cash. I've told you that when you have what can give you right to receive cash, does not require you to make any effort. When you have right to receive cash, you're a rich man because you don't have to lay a finger. Cash will definitely come because you have invested in the past. And that investment gives you right to receive. I mean, you don't have to do anything. Money will just be dropping. But if you buy a motor vehicle and you don't do anything, you will not make money. So physical assets or tangible assets or even intangible assets that are covered in IAS 38, like patents and all the rest, they don't give you right to receive cash. They only give you an opportunity to generate cash. So you need to really make or put in so much effort before you can make money from them. So items like that are not financial assets, and that is why they are not financial assets.
Sir,
Okay.
hello, sir.
Yeah, my brother, I'm with you.
So would a lease falls under financial asset?
Right to receive cash. Right to receive cash. Abi?
I said, yes. I mean,
The lessee has right to receive. It doesn't have to do anything. If it's a lease arrangement, the lessee would not have to do anything. I said the lessee. The lessor,
yes.
yes. The lessor will not have to do anything. The guy will just sit down in his house and they will come and deliver it to him every day. Deliver money to him every day. Deliver money to him every day. It's a right to receive cash. Especially if there's an agreement that you have to deliver on a daily basis, stuff like that. He has right to receive cash.
Sir,
Yes, please go ahead.
what about inventories?
Good question, Temitope.
Since you can sell it and make money.
Okay, but does inventory, will it give you right to receive cash?
I think so, because it's
Hey.
something that you have. Don't know how best to
Well, you
explain it,
have
but
to do.
I
You
think
have
it
to
falls
do
under the
something.
category.
You have to do something, like you have to exert a lot of effort. The energy people put in to sell inventory is not easy. To sell inventory, depending on what you are selling, whether clothes, whether wig, even this our class, though this is not inventory, it's not physical inventory. It's not easy to sell inventory. You need to put so much effort, so much effort. So that's not what I'm even talking about. Inventory is not a financial asset. It doesn't give you right to receive cash. So because you have inventory, they just imported goods from you from China. You now put everything in your warehouse. You now say, hey, yes, now I have right to receive cash. Let me go and sit down and sleep. You go hungry.
Okay, sir. So, if an item of PPE is leased out under a lease agreement, would it now fall under this financial asset?
Now you have right to receive cash, yes. Because the thing is that, you see, the thing is that just that you might have forgotten me because you have not read. You see, as soon as you lease out an asset, the first thing you do is you derecognize that asset from your books. When you derecognize that asset, what you will now recognize is a net investment in the lease. So it is that net investment in the lease now that is financial asset. Because as a lessor, you will have derecognized that PPE. It won't be in your books anymore because you have leased it out, especially if it is under the finance lease. You have revised what we taught you.
Yes, sir.
So again, financial asset is cash, equity instrument of another entity, contractual right to receive cash. Hello, Moyeno. Know that one first. Know it very well. Then you'll be able to identify most financial assets they will give you in the exam. You'll be fine. Cash, equity instrument of another entity, contractual right to receive cash. So again, I think you now understand what we are talking about now. So now let me now give you another example, or let me ask you another question. So if um uh, if you have a prepayment, okay, you paid for something in advance. What can you pay for? Let me say you pay for this class. These are lectures. You know?
Rent.
Or rent. Yeah, something like that. Rent.
I say
You
rent.
paid. Yes. I agree with you. You paid rent in advance. Prepaid rent. So can you classify that as a financial asset?
No, sir.
No, it won't fall under it.
Why?
It's an
First,
asset. Oh.
Because there is no
if-
right to receive cash, equity instrument, or contractual right to receive. It doesn't fall under the definition of financial assets.
Ah.
Intelligent. Okay, Hamis. Yeah, you wanted to say something now. Go ahead. Okay, so what are you then receiving now?
Service.
service.
Fantastic. Service. That's absolutely correct. Okay. Another example. If you'd have a contract liability, okay? If you have a contract liability, do you remember what a contract liability is? Do anybody here in this class remember what a contract liability is? Anybody?
An obligation to deliver a service.
Fantastic. An obligation to deliver a service. You see, last week or the week before, when I was teaching you revenue, I told you that when a contract does not meet those 6 criteria for IFRS 15, and you have collected money, that you don't recognize that money as revenue, but rather you are going to recognize that money as a contract, as a contract liability. Okay, something and which some other people will call deferred revenue. So my question is that, can you classify that deferred revenue or contract liability as a financial liability?
I think
Can
so.
you classify it as a financial liability?
Yeah,
No.
because
No.
No, we can't.
Why?
So because
To
the
me, you can because it goes along with this financial liabilities with another entity.
No, I've told you that we should leave this one. Otherwise, it's a long thing for us. We will not leave here till tomorrow. So let's focus on obligation to deliver cash alone.
okay, so the the thing is the agreement for the financial liability is the delivery of goods and services. For us to recognize a contractual obligation as a financial liability, it has to do with assets related to debt, loans, and agreements like that, not the delivery of goods and services. So it is not a financial liability.
I agree with you. I agree with you. I mean, if I want to summarize what you said, is that for a contract liability, what we are delivering is goods or services. But for us to have a financial liability, what we must deliver is cash. What we must deliver is cash. So know that one first, like I've been mentioning. Know that one first. So this other part of this definition, I might talk about it, I might not talk about it. It depends. But know this one first. Understand financial liability first as a contractual obligation to deliver cash. Cash. Okay? So we can then expand later. But for now, contractual obligation to deliver cash. If it's to deliver something else, that one is not financial liability. It's another type of financial liability entirely. So contract liability is not a financial liability. Okay, one more. Of course, I'm sure everybody will get this right. If you have tax liability, can that be a financial liability?
Yes, sir.
Why?
There is an obligation to deliver cash.
But it is not contractual now. It's
Well,
not contractual.
you could be prosecuted under the law. If you
But I don't have any agreement with anybody. You see,
It's a
what
social contract.
For
of that?
so,
I don't have agreement with the government. I don't have agreement with anybody.
so tax liability is a legal obligation, not a contractual obligation. So typically it will be based on taxable activities. So that it does not qualify as a financial liability.
Yes, more like that. More like that. So there is no contractual obligation there. So the issue of yeah, I mean the
I
way
guess
as is just very, very apt. Yes, my brother, can go ahead.
you said an agreement may not be written but implied,
Yes.
and the social contract implied. Every social contract is implied, is not written,
I mean, I don't
and,
have
and there
contract
is
with
a
government.
consequence. There will be a consequence if you fail to deliver that cash to the tax authority.
Yes, yes. For the fact that there is a consequence doesn't mean I have an agreement. Is I don't have an agreement with them. I'm forced to do it. That is not agreement. I mean,
Okay,
I don't have a choice.
okay,
It's like the way Damilola has actually put it is a legal obligation. And that is why I can be prosecuted for something I don't want to. I don't want to do it, but I don't have a choice. For a contractual, something that is contractual, it's mutually agreed. Everybody, I mean, you could say no. For tax, you cannot say no. You cannot, it's not possible. Yeah, Toyib, you can go ahead. Okay, I think he mistakenly raised up his hand. So
Hello,
let's
sir.
continue. Yeah, Temitope.
Sorry, my network has not been stable. The last one I you were talking about financial liability, whether it falls under this financial asset definition. I don't know how you
This is your network. It must be 7G. Temitope, we can't hear you. Your line is actually breaking. But I want to believe you can hear me. So so far I've said that you should focus when it comes to financial liability, see it as a contractual obligation to deliver cash. If it's to deliver something else, it is not a financial liability. It is not a financial liability. So when you have items like a contract liability, that is not a financial liability because what you're delivering is services, not cash. So it has to be obligation to deliver cash. Delivering any other thing disqualifies that as a financial liability. And I raised the issue of taxes, that when you have tax liability, so Olakule said, yeah, is a financial liability because there is an obligation to deliver cash. Yes, there is an obligation to deliver cash, but it's not contractual. I don't have a contract with the government. It's not a contractual obligation. No, I don't. Even though there is a legal obligation, even though there is an obligation, but it is not a contractual obligation. So tax liability is not a financial liability. It's just tax liability. And it's tax and to be presented in line with IAS 12. There's a standard for that. So that was what we have mentioned so far. So Toyi, you are raising up your hand. Do you want to ask a question or I should lower it for you? Let me lower it for you. Now, see, all of these things I've been explaining is actually in your notes. Actually in your notes. So, and we also defined equity instruments here and all of that. Okay. So before I move forward, there's this question here without solution that we really need to look at together. We have actually discussed most of it, but we still need to look at it together. So let's look at this question. It said the following relates to Net Worth PLC for the year ended December 2021. So required, determine whether the items above are financial asset or financial liabilities, and also state whether financial instrument exists as at December 2021. So there are 8 questions here. I really want 8 people to participate here in this question. I really want 8 people to participate. So the first one here, who is going to do the first one? So what you're supposed to do for us is that we are talking about net worth now. I know you will have owned maybe an asset or a liability. You just need to tell us, does that asset he has or liability he has, can we classify it as a financial asset or financial liability? And also you need to state whether a financial instrument exists. And you know that for a financial instrument to exist, there must be 2 parties. One party must have financial assets. Another party must have either financial liability or equity. So, there are 8 questions here. So 8 different people can talk. And if it's one person that wants to answer everything, that's also fine. So who is speaking the first one?
Hi.
Okay. Let me talk. Go ahead.
The net worth owns cash of 5,000. That's a financial asset.
Okay, that's correct. So is there a financial instrument? Does a financial instrument exist here?
Yes, it does. It does exist.
Okay, you know that for a financial instrument to exist, one party must have financial asset. Another party must have
either liability or equity.
So is there any, we have identified that net worth has a financial asset. Is there any other party that has liability or equity here?
No.
No. No.
Exactly. So financial instrument does not exist here, even though there is a financial asset. But for the fact that there is no other party that has liability or equity, it is not a financial instrument. Okay. Though net
Number
worth
two,
has a financial asset, fine. Okay.
number two, if
Okay. Number two, go ahead, please.
net worth owns a demand deposit of 1 million with First Bank, there is a financial instrument because two parties are net worth and First Bank.
What does net worth have?
Network has their financial asset, while First Bank has a financial liability.
That's correct. That's perfect. That's correct. So
Number three,
non-deposit. Okay, go ahead, please.
it's a financial asset, and it is also there is a financial what's it called? The financial instrument exists.
Okay, so what was financial instrument is so who has financial assets?
Yeah, net worth has a financial asset. Google Incorporation has a financial liability, and then a financial instrument exists between net worth and Google Incorporated.
Okay, that's a good attempt, but even
They
though
have they have
I agree.
financial instrument of shares, equities,
Network has financial instrument of shares.
equities. Yeah.
Go as equities.
Okay, I think so Damilola have said the correct thing. It's really Damilola that has said the correct thing. So net worth has a financial asset. Net worth is the investor here because he bought shares in Google. Okay, so equity instrument of another entity, that's financial asset. But Google doesn't have financial liability. Luckily, Google does not
Okay.
have a financial liability. What Google has is equity instrument. Don't forget, I
Yeah,
think
yeah.
what I'm teaching you is debt and equity. If you are raising money through borrowings, that one is financial liability. If you are raising money through people buying your shares, that one is equity. So what Google has is equity, not financial liability.
Yeah.
Okay, so net worth has a financial asset. That one is always very straightforward. But Google has equity instruments, not financial liability, because he issued shares. He issued shares. I hope that's clear.
Yes, sir.
Okay, so of
D.
course, financial instruments exist.
Latif D.
Yeah, Latif, go ahead.
Net worth statement of financial position includes inventory of 56,000.
Okay.
So there is no financial instrument and there is no financial asset. Inventory is not included.
That's correct. Inventory is not a financial asset. It is just inventory, line with IS2. It's just inventory. That is all it is. That's absolutely correct. Correct. E, who is doing E?
Number 5, E.
Okay, Gloria, go ahead.
Yes. Net worth sold goods amounted to 50,000 Solai on credit. So there is financial instrument, sir. So net worth is the account receivable and Lai is the account payable actually. So there is and net worth has financial assets while Lai has financial liability.
That's absolutely correct. So net worth has a trade receivable, which is a financial asset because there's a right to receive cash, while Lai has a trade payables, which is a financial liability because there's an obligation to deliver cash. Fantastic.
Number 6.
Okay, Olakule.
On December 2021, net worth received an advance payment of 250,000 from one of its customer, Muri Limited, to deliver goods in January 2022. Yes, it's not a financial asset. And although a contract exists between them, but it's not a financial asset.
Why?
Because there is no right to deliver cash, equity, or or any of such things.
What are we
Only
delivering?
service. Only goods. Yeah, I mean
That's
the only things to deliver is goods.
That's perfectly correct. Perfectly correct. That's intelligent. So network has received money in advance, but what is delivering to Muri is goods. So it doesn't have a financial liability. That's contract. This is what we call contract liability. This contract liability, it gives like a contractual obligation to deliver goods. Okay, not cash. So you're correct. Oh. Yeah.
Yeah. Sorry, Tori.
Who is doing the next one?
Toyib.
Yeah.
Huh? Who is doing the next one?
So for the next one, which speaks about current tax liability
No,
and
somebody is doing that already. Toyebu is doing that already. You can
He's
see
the
okay.
one
Mr.
speaking.
Sorry about that.
Mr. Wasim.
I
Yes.
can't hear him
I
now.
hope you can get the answer that Toyebu is giving you, sir, on the group chat.
Okay.
Is
Oh, okay.
Mike 40.
I've seen it. I've seen it. He wrote it on the group chat. He said there is no financial assets. There is no contract. There is no financial liability. Okay. That's correct. Okay. So there is no financial asset here because, like we have explained before, current tax liability is not contractual because there is no contract. So, and as well as deferred tax liability. So here, it is not a financial liability. It's simply current tax and deferred tax as presented. Okay, so who is doing the last one?
I'll do the last one, sir.
Okay, please go ahead.
Network purchased the Bitcoin of 5,500,000. Yeah, this is more or less an intangible asset.
That's correct.
Yeah.
That's actually correct. How did you know that?
Yeah, I've thought of, sir.
Okay. You're sure correct. But why is it not a financial asset?
Because one I mean earlier today you explained to us that PPE would not fall under financial instrument, so we can't classify it as a financial asset until probably it falls under a finance list whereby it will not be investments in lease and things like that. So I feel since this is an intangible asset, the same would also apply in this regard.
Okay, so I mean, you're perfectly correct. Bitcoin is an intangible asset. Is an identifiable non-monetary asset without physical substance. Bitcoin does not give you right to receive cash. Bitcoin is not cash. So when you invest, when you buy Bitcoin or all this cryptocurrency, they are not cash. Some people will argue that they are cash now. Maybe I can use it to buy something. No, it's not a medium of exchange that is generally acceptable. So it cannot be categorized as cash. So it doesn't fall under financial asset at all. It's usually an intangible asset. It can also be an inventory. It can also be an inventory, especially for those guys that have an exchange where they sell or resell these coins. Those ones would have recognized this Bitcoin as an inventory because they are holding it to resell. Okay. Damlola, go ahead.
Yes, sir. So my question is relating to this Bitcoin. What if the company held it as an available for sale instrument? How do we treat it? What do we classify it as?
Inventory.
Okay, thank you.
Yeah. Okay. Recognition and the recognition of financial assets is the other part. Before I move to this other part, so you see this thing I just solved for you here. Last diet, there was a question on it, last diet, and they just I think they gave us like 4 or 5 of these items. Not this one specifically, those ones were a bit more difficult than these ones. But at least if you understand this, you should be able to attain that for 15 marks under section C or thereabouts. I can't remember. So it's just for you to identify whether it's a financial asset or financial liability and whether a financial instrument exists, something like that, last diet. So these are questions that, and that was the first time they are going to ask that kind of question. I've never asked it before. So, I mean, we're happy because this I've been teaching students this, they never ask, and they asked that part last diet. So you can check it out. I'll post it on the group for you to check out. Okay, so now let's go to the other part of this class, which is talking about recognition and the recognition of financial instruments. You see, what we have done so far, for me, is like 50% of what you need to know is the most important thing here. For you to be able to see a transaction and you're able to identify whether that transaction is a financial asset, financial liability, and even if a financial instrument contract exists, that is the most important thing for you at your level here. So now, when you now identify that, then that's when you can then start thinking about recognition or derecognition. Okay, so when you have identified that a financial instrument exists, then you then have to put it in your books, and that is recognition, and that is covered under IFRS 9 under financial instruments. So you see, there's a criteria for recognition. So it says that a company recognizes financial asset or financial liability when the company becomes a party to the contractual obligation of the instrument. When it becomes a party to the contractual provisions of the instrument. When it becomes a party to the contractual provisions of the instrument. That is when you can recognize or record a financial asset or a financial liability in your books when you become a party to the contract. I mean, that should not be so much to remember because a financial instrument itself is a contract. So it is when you are a party to that contract that you can either have a financial asset or liability, and that is when you can recognize it in your books. And the key question is, when can you become a party to a contract? You see, becoming a party to a contract is usually at the earlier of the date when you signed the contract, okay? At the earlier of the date when you signed the contract or when you made a commitment. Because there are some people that will just invest or buy shares without, they will just send money to their stockbroker. That, okay, help me quickly key in. Then later they might not even sign any contract. You see, that commitment itself shows that you have an agreement, okay? And you have a contract. And you can go ahead and recognize a financial asset, as the case may be. So when you become a party to a contract, again, when you are selling goods, before you can recognize trade receivables, IFRS 15 already taught us that you must have performed. You must have delivered. Otherwise, you cannot recognize trade receivables. You must have performed, you must have delivered, right? So that is that for recognition. You see, they can ask this for 2 marks. That was the recognition criteria for financial instruments. So whether you have a financial asset or whether you have a financial liability, you recognize it when you become a party to the contract. Then the second one is derecognition. When do you derecognize a financial asset? You see, you derecognize a financial asset when you have, it says when your right to the cash flow from the asset has expired. When your right to the cash flow to the asset has expired. That should make sense to you because derecognition means removal. Derecognition means you are done with it, then remove it. So you already know that financial assets is a right to receive cash. Abi? Right to receive cash. So when you have received all your cash, when your contractual right to receive cash has expired, remove it. To recognize it. It's time to move on, my brother. You have collected all your money. Move on. So when contractual rights to the cash flow from the financial asset has expired, do recognize. Or if the entity transfers substantially all the risk and reward of ownership of the financial assets to another party. And this happens when there is an unconditional sale of the financial asset. When there is an unconditional sale of the financial asset, that is when you have transferred substantially all the risk and reward of ownership. And this will happen when you would either sell the shares that you bought or you sell the debt instrument that you did. It means you have transferred substantially all risk and reward. So, of course, the sale must be sale. Important is the sale in line with IFRS 15. That's where all these ones are coming in because there are some sale that will be conditional, and the conditionality might disqualify it from being a sale. I won't really dive deep into that because I didn't teach you all those details in IFRS 15 at your level yet. Okay, but really, this can result in the recognition of a financial asset when your right to cash flow from the financial asset has expired, and when you have transferred all risk and reward of ownership of the financial asset to another entity, that is when you have sold the financial asset. Next one is derecognition of financial liability. So when do you derecognize a financial liability? Don't forget, financial liability is an obligation to deliver cash. So logic will say that when you have delivered the cash, then move on. Yes, of course, yes. That is when you derecognize it. But the standard use a fancy word here that you should derecognize a financial liability when it is extinguished. Extinguished. And when we say extinguished, is either when the obligation in the contract is discharged, is cancelled, or expires. Okay? So delivering cash is not just enough. I mean, some people will say, okay, don't worry about the cash, I forgive you. I'm discharging you of this obligation, or we just cancel the contract entirely. So that is why we can't just say, okay, when you deliver the cash. So extinguished is the more appropriate word to use. So that covers everything, whatever means, whatever way in which you are free of the liability. So extinguished is just the right word for it, which is either when the contract is discharged, when it is cancelled, or when it is expired. So either of those three would make you derecognize the financial liability. Okay. And that's the recognition. And majorly, that is what you need to know. Even though I put some other details here in your notes, doesn't really concern you that much. So I'm talking about other things that could lead to the recognition of financial liability. Usually where there is an exchange of one financial liability for another, it could lead to the recognition of one financial liability and the recognition of a new one. Another one is when there is a substantial modification of the terms of an existing financial liability. Yes, that could also lead to the recognition of the original financial liability when there's a substantial modification. Substantial modification is when the differences in the cash flow under the old terms and under the new terms result in differences in cash flow of at least 10%. So you don't have to really bother so much about those details, right? So that's the recognition of financial liability. So again, for financial liability, when it is eventually derecognized, it might result in having a profit or loss simply because when you have a financial liability, there will be an amount that you are owing. So you might be owing, let's say 10 naira, and you eventually settle out for 18 naira. That was what you used to settle to do the final settlement. So probably the guy discharged you of the remaining 2 naira. Now, okay, don't worry about that. So that remaining 2 naira is a profit on the recognition for you, which you have to recognize in your profit or loss. Okay, so that is another one that we need to note. Okay, so that is recognition and the recognition of financial instruments. Any questions? Any questions? Okay. So finally for today is measurement of financial instruments. That's the final thing for today. Measurement of financial instruments. So we are going to look at 3 financial instruments. Number one is financial asset, financial liability, and equity. You all know, as I've already mentioned those 3 to you already. So we'll pick them one by one. I'll quickly look at it today. Then we'll probably solve questions on them next week. So this text book didn't talk about equity. It didn't talk about equity because when you have equity, it means that you have share capital. Equity is simply share capital. That is what equity instrument means. So how do you measure your share capital? So if you don't know this before, even those of you working as accountants in companies or who are an auditor, so you should know that share capital are usually measured at nominal value. Again, share capital are measured at nominal value. And where do you get nominal value? You get it from the CAC documents of the company. You get nominal value from CAC documents of the company. So usually when you pick up a CAC document, you would always see what the nominal value is. So share capital is always measured at that. So if you eventually issued your shares above the nominal value, that excess over the nominal value is usually recognized in share premium. Is usually recognized in your share premium account. But ordinarily, you recognize it in, you measure it at nominal value. So that's that for equity. So let's pick on financial assets. So measurement of financial assets. So I'm going to focus on equity and debt for financial assets, because don't forget, financial asset is three things. Financial asset is cash. Financial asset is equity instruments of another entity. And financial asset is also a contractual right to receive cash, which is investment in debt. So I'm not going to focus on cash, because how do you measure cash? Your cash is your cash. There is no other way of measuring it than your cash. Cash is cash. It's nothing more. Okay, so no issue with that. Everybody knows how much you have as your cash, right? So the other two is what we will look at, which is when you buy shares in another company, an equity instrument of another company, or when you have a right to receive cash. How do you measure those ones? That will be our focus for tonight. So now, the first thing is this. You see, all financial assets, whether debts or equity, are initially measured at the transaction price. And when I say transaction price, I mean the amount that was invested or the price that was paid. Of course, when you would have invested an amount. So the amount you invested is the amount at which you are going to measure that financial asset initially. Okay, I've been talking for too long. So who can tell me the double entry for that? Let's say you bought, you lent more the money. Let's say you lent, who can tell me double entry for that?
You credit cash or liability. You credit cash or bank.
Yeah, now, what do you debit?
I'll repeat the question again, please.
So what's the double entry? When you lend somebody money.
You credit liability now and debit.
You do what?
You credit bank and
Yes.
debit financial assets.
Thank you, Elaine.
Yes.
Thank you, Elaine. You credit bank, you debit financial assets. You debit financial assets. So, I mean, that is what you debit. So if what you have bought is now shares now, if it's investment in equity, so you can be more specific and say, okay, investment in equity, but it would simply, on the face of the financial statements, it would be a financial asset. That's what they will call it. Okay. But now let me now go deep into, I mean, you have already known the primary double entry. You credit bank, you debit financial assets. So I'll pick those two items. Okay. The first part is if what you have bought is shares, which is what I want to talk about first now. Then I'll talk about the second part very soon. Okay, so if you have bought shares now, if you have invested in shares, so investment in equity, and this investment in equity, yeah, I'm not talking about what Mr. Kazim is teaching you, associate, subsidiary, and all of that. No, this one is the ones that are just simple investments that does not give you so much holding. I'm just talking about those simple investments that you have. Okay. So when you invest, I mean, initially, the date you invested, how much you record or measure it is at the transaction price. That one is clear. Credit bank, you debit financial assets with that amount. However, on that same day that you acquired that shares, before you go ahead and debit financial assets, you need to understand the nature and the intention of that investor for buying that shares. Because this is what would determine how you are going to classify the equity instrument, and ultimately is measurement at the end of the year. So when you have shares, when you buy shares, generally, the reason almost everybody will buy shares is either to hold it for short term or trading, or to hold it for long term. Either to hold it for short term or trading, or that is why it's either of these two. And how do you separate between these two? You cannot separate it looking at the number of years. No, it's not possible. The difference between these two, I mean, for the long term means that you don't have plan of reselling those shares that you bought. You don't have plans of reselling it. I mean, you want to hold it for life to the foreseeable future. So if you have plan of reselling, whether in the next 5 years, in the next 7 years, in the next 10 years, in as much as you have a plan of reselling, then mostly that will be that you are holding it for the short term or for trading. So the distinction between these two is more of, do you have plan to sell or not? Now, why are we bothering ourselves about this, knowing why they are holding it? It's very important because we are talking about a financial asset here. It's important for people that are studying your financial assets. By the time I say financial asset, that are studying your financial statement to understand the nature and characteristics of that financial asset that you are putting in your books. Because we are saying financial asset is, one of it is if you buy shares, we need to know these shares you are buying, is it something you have bought for the long term or for trading? So that if the company in which you have invested so much shares, probably you bought shares of a company, and later, maybe after a few months or few years, that company collapsed. So somebody that have read your financial statement and saw that, this guy said he's buying these shares for the long term, well, that means he has lost all this money. I mean, we should be able to do that. And that is why you need to explain that financial asset. Are you holding it for the short term or are you holding it for the long term? And the way we are going to know is this. If the intention is to hold the investment for the short term, you are going to classify that investment in equity instruments. You classify it at the date of acquisition. Okay, the date you bought those shares, you classify it at fair value through P/L. That's the name you call it, fair value through P/L. If the intention is to hold it for the short term. But if the intention is to hold it for the long term, then that investment in shares will be classified at the date of acquisition at fair value through other comprehensive income. At fair value through other comprehensive income. So when you told me, when Ellen said you would debit financial assets, So the thing is that you will not call that account just financial assets. You will call it either financial asset at fair value through POL or financial assets at fair value through OCI. So by the time you are crediting bank, you are going to be debiting financial assets at fair value through POL or financial assets at fair value through OCI. So you as an accountant, when you see such, you see that this company bought shares and they have described that account as investment in equity at fair value through POL. You should know that their intention is to hold it for the short term or for trading. But if they classify it at fair value through OCI, then you should know that their intention is to hold it for the long term. And that is why this is particularly necessary for equity investments or for financial assets generally. So summarily, investments in equity can be classified into two. They can ask you this in the exam. It's either at fair value through POL or fair value through OCI. That being said, so if you have a company that purchased 5,000 unit ordinary shares from another company at 2 naira each, and the investor intends to sell the ordinary shares before the year end, that means he's holding it for trading. So how is he initially measured? So he will initially measure it at 10,000 naira, which is the amount he paid for the shares. There are 5,000 units at 2 naira each. And also at this same date, which he bought the shares, he's going to classify that investment. And he's going to classify it in this case at fair value through POL because he intends to sell it before the year end. So hence, he was going to debit financial assets at fair value through POL credit bank. That is how it is presented in the books. Debit financial asset at fair value through POL and credit bank. I'm done with investments in equity. Any question?
Yes, I have a question.
Okay, Tim Tope.
Okay, so all these financial assets I've been talking about all this while, and even the liability part of it, it's going to be reported in statement of financial position, right?
Yes.
Okay, so now, like you have said that this one's, for example, be investment in equity through either other comprehensive income or POL. Okay, those ones that has to do with cash or receivables. Are they now going to be, how do we classify that? How do we translate it or something?
So this one is just when you the one I've just taught now is when you bought shares, when you buy shares. So for trade receivables, it's just majorly trade receivables. So we will not really classify those ones. I'm not going to get to those ones yet, but for now, this one is when you bought shares. This is investment in equity. That's what we are dealing with for now.
Okay, sir. Thank you.
Okay, sir, I have a question, sir.
Okay, Kale.
Yes, sir. So using the example that you just mentioned, yeah, I mean the initial measurement would be just like you mentioned, will be initially measured at the cost of the investment or at the cost of the ordinary share, which is 5,000 shares times 2. Now, can you explain with how to measure it at fair value through POL using this example? I mean, what will the amount be? Will it still be the same?
I'm not getting there. So that will be at the end of the year. So I'm still at the date of acquisition now.
Okay.
Yeah, I will still get there very soon. So all of this is happening at the date of acquisition, the date you bought those shares. the date you bought those shares at 1st January 2024. So if you look at the question, how will this investment be initially measured and classified? Okay, I'm still going to get to at the end of the year. So I think all of you already understand this. You are just thinking ahead, which is beautiful. Okay, so yeah, go ahead, please.
No, sir. It's because you mentioned in the solution that it will classify the investment at fair value through profit or loss, as it intends to sell in the short term. So that's where I got confused.
Okay, no, don't get confused, right? So all I just need you to know is to know when you are classifying at fair value through POL and when you are classifying at fair value through OCI for now. So since this guy is selling before the year end, that means he's holding for the short term. So he will classify that financial asset at fair value through profit or loss. That's what you are knowing for now. So I will then teach you later how to treat that. I'm not there yet. So we are debiting financial asset at fair value through POL and credit bank. That's all I wanted to know.
All right.
So Damlola.
Yes, sir. So I just wanted to say this. I'm not sure if I'm right or wrong, but that's something that I've always said in my head. So because they are financial instruments, which is usually recognized in the balance sheet, the fair value through POL or the fair value through OCI is the revaluation surplus or deficit on the instrument. So I'm
No,
not sure if I'm correct on that. Okay. So please, can you clarify?
I'm not there yet.
All right. Thank you.
Okay. So I'm still going to get there very soon. But for now, that's the name. I just need you to get used to that name first. And when you classify at fair value through POL, and when you classify at fair value through OCI, that's what we need to know for now. Okay. What I needed you to ask is, should be around what happens at the beginning of the year or what happens at when you bought shares. But no, none of you have really asked that. So I'll ask you. So you see, typically when you buy shares, you would use a stockbroker. They will charge you all sorts of charges. They will charge you. So really, it's not just this 10,000 naira this guy will pay. He will pay more. He will pay Kinecon fee, stockbroking fee, agency fee, professional fee, processing fee. He will pay all of that. So since you did not ask, that means you know. So I need you to tell me the double entry for that. So let's say this guy paid let's say 5%. Let's say he paid 500 naira additional to his broker. The shall add 500 naira. So what will have been the double entry for that?
Let me attempt, sir.
Please do.
Okay, so 10,000, we will credit bank with 10,500. That is the total amount of the cost of the shares and the amount paid to the broker. We'll debit.
Let's do the charges alone, the 500 naira alone.
Okay, the charges alone. We'll credit bank.
Okay, with 500 naira.
With the 500 naira. And then we'll debit transaction, the shares expenses or expenses on the shares, if there is anything like that.
Okay, let's say we call it transaction cost.
Exactly.
So where will it go? Are we expensing it or capitalizing it?
No, we are going to capitalize it, sir.
So meaning we'll add it as part of this financial asset.
Yes, sir. It's part of the cost of investment.
Okay, good initiative, Olakunle. If you had said you expense it, that would have also been good initiative because both are correct. So, and this is where this classification comes in handy, right? If the way you have classified is fair value through POL, which means that you intend to sell it in the short term, you expense that transaction cost. You expense it. It goes to P&L.
Okay.
If the way you have classified it is at fair value through P&L. But if your choice of classification is at fair value through OCI, you capitalize that.
Okay.
Yes. You capitalize that. Another question I want to ask you. Your selection of a classification, is it a selection of an accounting policy? Yes, of course. So what if you now change? You change from fair value to PL to fair value to OCI. Is that change in accounting estimates or change in accounting policy?
That would be estimate, not policy.
It's policy. It's policy, it's not estimate. I've told you that changes in accounting estimates usually arise as a result of new information, new experience, new circumstance. That is where you change estimate, you update your figures because of new information. It's just like you are using 5 years for your assets before, but along the line now, you now saw that, no, this asset can go for 7 years. It's because of experience, but this one is an accounting policy thing that affects your recognition and measurement. So when you change it, it's a change in accounting policy. And I know that I've taught you to change accounting policy last week. So I've actually done a lot in this class. Okay. So that is that at the beginning of the year. And I've also dealt with transaction costs. Cost you pay to your broker. If you classify the investment at fair value through POL, you would expense that. If you classify it at fair value through OCI, you capitalize that. Okay. So at the end of the year, this is where all of you have been asking. At the end of the year. So at the end of the year, you are still going to measure that financial assets the same way you had classified it. The same way you had classified it, either at fair value through POL or fair value through OCI. So that's how you measure it at the end of the year. So you will call it financial asset at fair value through OCI or financial asset at fair value through P&L. So what is now the difference between the two? Typically, we are talking about shares now. When you buy shares, share prices fluctuate, it changes. Okay, and share price is what we call fair value. So in the case of this guy now that bought these shares at 2 naira at the beginning of the year, you agree with me that at the end of the year, it's not going to remain at 2 naira. The shares might have changed to, let's say, 3 naira. So when the shares increases to 3 naira, this 10,000 you recognize at the beginning, will it remain 10,000? No, it will have increased to 3 naira times 5,000, which is 15,000. That means you have made a gain of 5,000. Okay, that gain, we don't call it fair revaluation gain. No, we call it a fair value gain, which is why when Daminola asked me that is it that this fair value, whatever, is it related to revaluation? I said no, because this one is a fair value. It's a fair value. Fair value is quite different from revaluation in this context, right? So for at the end of the year now, that gain I've just showed you, if you are measuring it at fair value through POL, those gain of 5,000, like I've just showed you up here, we are going to recognize it to POL. We are going to recognize it to profit or loss account. But if you are measuring it at fair value through OCI, that gain, you are going to recognize it into your OCI. That gain will go to OCI. And that's the difference between measuring at fair value through POL and measuring at fair value through OCI. I hope that is clear.
Mm.
And that is all about investments in equity. That is all about investment in equity. So this note you have with you is actually very explicit. It takes you step by step. Everything, just like I'm explaining it. All you just need to do is just to revise it. When you revise it, you have done yourself a good, because it makes it easy for you to understand. And this is a topic ICANN would mostly ask. You would mostly find it in your exam, mostly. So now I'm taking it step by step. Okay. Just give me like 15 more minutes, then we'll go and sleep. Let me just deal with, so that I will know that I'm done with financial assets. So next week, I will just deal with financial liabilities, then we'll solve questions. Then we'll end up with financial instrument. So let me just finish this one. Just give me 15 more minutes. Okay. So investment in debt. So this is typically when you buy shares. Sorry, please. This is when you lend money to somebody. This is when you lend money to someone. Like bonds, loans, or loan, or other instruments which are likely to carry interests and of course and a capital element of repayment. So that's usually the characteristics of when you lend somebody money. You would get interest, and also you would get your money back at maturity. So I've already mentioned that all financial assets are initially measured at transaction price, which is the amount you invested or the amount you lend someone. That one is established. So in addition to that, when you lend money to someone, you would also need to classify that financial asset too, just like we did for equity. You would also need to classify it. And there are 3 possible classifications, okay? But before I go to those 3 possible classifications, let me tell you the basis for the classification. The basis for the classification. So what will inform how you classify these debt investments? So the first one is your business model for managing the financial asset. That's the first basis, your business model for managing the financial assets. And when I say business model, it means how you want to make money from these investments, from these financial assets, how you want to make money. How do you want to make money? That is your business model. And the way we make money when you buy debts, when you lend somebody money, is in 2 ways. Number one is you just collect your interest and principal repayments. That's a typical one, to collect interest. You see, that's a typical one. It's just like this, like government has issued another bond. You're trying to mop up 150 billion from circulation. Of course, they will give interest. So most people will invest because of that interest. Like yesterday, CBN raised MPR to 27.25%. So we expect a lot of investors to come in. And because we raised the interest rates. And last week or last 2 weeks, US reduced theirs by, I think, 50 basis points to 5%. Even in the UK and other European countries, they reduced their interest rate. So we expect that investors will now bring in their money because they are looking for an high interest rate environment to bring in their funds. Of course, Nigeria seriously needs that Forex. So, but the point here is this business model. How do you make money when you invest in debts? So the first way is that you're going to collect interests and principal. That's one. Number two is, in addition to collecting interest and principal, you can also sell that financial asset. Okay, so some people might have the intention of selling. They might not wait to maturity. They might just sell along the line and say, okay, I want to exit this financial asset for whatever reason. Of course, majorly because probably there is another country or another investment that is giving an even higher interest rate. So they will just exit this one and go and buy that one. So, and of course, collecting interest and of course, principal is a major part of buying debts, investing in debt. So it's always a constant thing. It's a way you make money that's constant. So that's why for your business model, is either you're collecting interest and principal, or in addition to collecting interest and principal, you can also sell. Okay. And there's this other one, which is the contractual cash flow characteristics of the financial asset. You see, what this simply means is that there has to be a contract. There must be a contract that will specify that, okay, you are entitled to interest and principal. There has to be a contract. Okay, so these are the two ways or the two bases that will determine how you will ultimately classify or categorize that debt investment. Okay, so now let's now go to the classification itself. So there are three classifications, like we have mentioned here. There are three. So number one is amortized costs. Amortized costs. Okay, where is number two? I'm supposed to list it first. That's number one. So number two is this fair value through OCI, just like for equity too. And number three is fair value through POL. Amortized cost, fair value through OCI, and fair value through POL. Those are the three classification of a debt investment. So you see, for amortized costs, you classify a debt investment at amortized costs if your business model, just like I've explained here, is that you want to collect interest and receive principal at maturity. That's your business model. Is this first one here. Just to collect interest and principal till maturity, meaning you don't have any plan of selling. And of course, this one is a constant thing. There has to be, which is the contractual cash flow characteristics test. There must be a contract that will specify that, okay, you're supposed to collect interest and principal. There must be a contract that will specify that. Okay, and that is how, or that's the basis for classifying a debt investment at amortized cost. The second basis, which is this, which is fair value through OCI. Fair value through OCI. For this one, Your business model must be that in which you would collect interest and principal and also sell the financial assets. That's a clear difference between classifying at amortized cost and classifying at fair value through OCI. Is the fact that for fair value through OCI, your model, the way you want to make money is in addition to collecting interest and principal, which I call contractual cash flows here, you can also sell. So when the examiner tells you that this guy is ready to sell, if he sees an opportunity for higher yield, then you know that you should classify that debt investment or instrument at fair value to OCI. Why the third one, which is fair value to POL, this one is a default classification in the sense that primarily financial assets, debts to be specific, should be measured and classified at fair value through POL unless they are measured at amortized cost or fair value through OCI. So what I'm saying primarily is that debt investment, you should classify and measure it at fair value through POL. It's a default. That's the expected way you should classify and measure it. If you don't want to just stress yourself, just measure it at fair value through POL. However, by the time you go ahead to check the business model of each of the instruments, then that is what would then take us to measuring it and classifying it at fair value through OCI and fair value through POL. So fair value through OCI and amortized cost. And for fair value through OCI, it simply means that the way you want to make money is to collect interest and principal and also sell. And for amortized cost is simply to collect interest and principal. Okay, so I'm going to stop here for today. I won't really solve any questions for today. So all these things I'm showing you are the questions we'll solve next week. Then move to some other things. So, but primarily, I will stop here. So next week, I will then explain those three classification and measurement to you further. But for today, you have learned that debt investment, okay, can either be classified at amortized cost, fair value through OCI, and fair value through POL. So for amortized cost is where your business model is to collect interest and principal. And of course, there must be a contract that will state that you're supposed to collect interest and principal. For fair value through OCI, your business model is to collect interest and principal and also to sell that financial asset. And of course, there has to be a contract that will state such. Why fair value through POL is a default classification. So next week, that's the first thing we will do in the first 30 to 40 minutes of the class. I would explain how to determine amortized cost, explain how to determine fair value through OCI and fair value through POL. Then we'll solve some other past questions and we'll round up the class on financial instruments. Do we have any questions?
Yes, I have a question, sir.
Okay, go ahead.
Okay, so under the debt instrument, we talked about the business model and the contractual cash flow. So if the intention of the holder of the debt instrument is to convert it to equity in the future, is that covered under this standard or maybe in a separate standard?
Yes, is actually covered, right? So we're going to do that next week under compound financial instruments. I should teach you compound financial instrument. It's covered there. So you will see that there.
Nice.
Good question. So that last diet question I'll share with you, or you can also check it yourself. Is on ICANN website. So you'll see it there. I think it's question 5 or thereabout. Thank you very much. Have a wonderful night.
Sorry,
Good night, sir.
Yeah.
Hello,
Good night, sir.
sir.
Good night.
Hello, sir.
Yes. Go ahead, please.
Under which instrument does derivative fall into?
It's a separate instrument on itself, on its own.
Okay.
Yeah, it's separate, and I'm not going to teach you. All right. Good night.
Good night, sir.